think everyone here probably knows everyone on the panel, but just so to be absolutely clear. So immediately to my left is Euan Munro, who's Chief Executive of Aviva Investors, then Peter Preisler, who is Head of Global Investor Services, EMEA for T. Rowe Price, then Jamie Hammond. I have to be careful to remember it's Chief Executive of AllianceBernstein now, rather way. And then Neil Carnegie, Carnegie Fund Services, and Alexander Schindler, member of the board of Union Investment, but also chair of EFAMA for a couple more months. 5 days. Okay, thank you. So we were presented with, if you like, what I would call our exam question, which we're going to kick off straight into. And I suppose the key thing, let's start kind of the end of the question, which is the question supposes that there are challenges in MiFID II. So I don't know, Peter, do you want to just start it off in terms of some of the key challenges you think, and your thoughts particularly maybe around the whole area of inducements, and distribution changes there?
Sure. Well, I think one of the obvious challenges is that MiFID II is supposed to be a simple regulation, and the interpretation is so different across the space. So we have all variations of ways to try to live up to MiFID II. Furthermore, we also have USITS distributed outside Europe. So we really, as a provider, has to cater to Asia, cater to LATAM, and then we have many different versions in Europe. And all of that both have elements of transparency or lack of transparency. It also have elements of paying or not, and it also have elements of paying someone else, which we used to pay. So it's pretty intransparent.
And I suppose, are there going to be changes in practices? Jamie, do you see changes in practices particularly around Europe? Do you see these evolving in some way?
Yeah, I think there will have to be some changes. Certainly if you look at the inducement aspect of it, we're already seeing what I would call, and I think I've mentioned before, a standardization, if you like, of the level of inducements, which I prefer to call the distribution cost. Because I don't think any particular distributor is going to want to answer the question of why you're giving more business to asset manager A versus asset manager B if the levels of rebates are different. So I think in order to level the playing field and to make sure the distributors are putting the client's interests in mind, I think you'll see a standardization almost, if you are working as a distribution partner, of what that cost will be. And it's probably going to be at the higher level of the spectrum of where rebates are today than the lower end of the spectrum. And I think then, if you then play that forward and think about the many aspects of MiFID II and just the longer term, more detailed implications, say, of target markets and identifying target markets. If you play that forward as well and you look at some of the guidelines from ESMA, there's a requirement for us to almost make sure that our distributors and distribution partners are targeting the right markets. And then if you are doing that and you think about putting the end investor first and what's in the best needs of the customer, think about what that means for us from our servicing and our marketing support model. I don't think you can adopt a one-size-fits-all marketing approach if you are potentially identifying multiple target markets working across different types of distribution. So I think how we adapt our marketing model, our service model, our communication style is going to have to be very almost sub-channel focused. So that will increase a little bit of complexity, and that always adds a layer of cost.
Yeah, so that's both channels and geographies, as it were. There's
Indeed.
Different. Yeah, so, should we just try to put that into even more concrete form, maybe looking into particular jurisdictions? Alexander, from what you see in the German market, just the broad impacts of MiFID, but around the inducements, how do you see that playing out?
I think currently, I think in particular the distribution side of the business is reconsidering its product offering, and as Jamie said, also the defining the target markets, the right product for the right client. You know that in most continental European markets, distribution is bank or insurance dominated in a way. What I can tell is, I mean, either bank distribution declares itself dependent to continue receiving retrocessions or distribution fees, or independent, and then you have to comply with all MiFID requirements. That's the distribution side of the business. It could well be that banks are reducing the number of funds they offer because of the challenges of target market definition and so on. And for us as product providers, it will be extremely important, as it has been said, to define the right product for the right client, and as well, in a way, supervising distribution, whether they really comply, because at the end of the day, that might backfire. Another topic which is, from my point of view, or has been totally overlooked, is research unbundling. I think this will have an even more important impact on the industry as a whole, but also on other financial services like research and investment banking, and this has to be seen.
Okay, yeah, it is an issue that's talked about less, actually. I suppose Aviva Investors, headquartered in the UK, interesting in itself, but then you operate, globally pretty much. I mean, you're just picking up some of the points, and what's your view of the impact of MiFID for you, global business?
Well, I suppose it just complicates the picture somewhat. I think clearly objectives of MiFID II, to improve transparency, suitability, value for money. Nobody is going to argue against these things. It's to some extent it's motherhood and apple pie. But having said that, you might have said that political leaders agreeing with the Paris Agreement was motherhood and apple pie as well, and we've just seen a spectacular break from that. So I think you do need to have legislation that states these things down, but it is incredibly complicated. And one of the things we've seen on the matter of, say, inducements, now people are paid for advice and so on. We've had RDR in the UK for some time, and what's left is an advice gap. So my counsel would be, as we roll these things out, be very, very careful about the unintended consequences, because you do end up, as we've seen in the UK following RDR, with a whole bunch of people who, in my view, are not getting great counsel as to how to invest the money. And you tend to get a race to the bottom. So maybe we'll be I might want to touch on some of the biases that I think are behind some of the thinking in RDI, in MiFID II, and the FCA's approach, that cheap is good, that the only aspect of fund management is the return outcome rather than the risk outcome. And actually, particularly when you get down to the less affluent sector, the taking responsibility for the risk profile of the fund rather than just making sure it's cheap is, I think, absolutely critical, and they're not getting that advice. So my concern is we'll have this great big piece of machinery with noble aims that will have unintended consequences. Yeah.
And a large amount, we've just really been talking about inducements. MiFID, much bigger than that as well to swallow, isn't it? I mean Neil, from a sort of Swiss market perspective, maybe particularly, a very different marketplace again. Very closely connected with Europe, but not actually in the EU. How are you seeing MiFID impacting your own business and clients?
From our perspective, we're dealing with 175 different distributors domiciled in Switzerland. So we actually go through the due diligence once a year on this population, and we go and perform interviews, as I did last week prior to coming to Berlin. And what's going on at the moment is, regardless of the size of the institution in question, there's a lot of work in preparing MiFID II filings, target market returns, and going back into their client databases to determine which box these individuals fit into, and the nature of the relationship that they have with these individuals. And what's becoming more and more relevant is, and this isn't MiFID II, this has been since perhaps 2008, 2009, is the sources of revenue. And obviously, as everyone's alluded to, trailer fees and retrocessions and inducements. Just to touch on that for 1 second. The model the general consensus in Switzerland is that the model on living off trailer fees has its days numbered. It's already shifted now, whereby 60% of the assets placed in investment funds aren't attracting trailer fees. So you have it on around about 40%, and that's deemed to be diminishing. And so when you look at the reporting on target market reporting, you find that you've got more and more mandates, and they come in two forms, one of which is a advisory mandate, fiduciary responsibility right in the heart of it, assessing the client's profile and the risk profile and the desired objectives of the outcome. And then on the other hand, you have the discretionary mandate model, which is the preferred model because it has perhaps more interesting fees on it. And when you're putting shares of investment funds into either category, you have the question, as was alluded to the gentleman from the FCA, about your fiduciary responsibility, which very crudely stated is, can you eat on both sides of the table simultaneously? And in fact, people have decided, well, perhaps not. And therefore, there's dependency on trailer fees and incentives has diminished and has been given up to 60%. And therefore, that's been compensated essentially by fees being from mandates, and they're two different forms, and obviously other pricing mechanisms for platforms. And at that point, I'll stop.
That's interesting. I wasn't aware of the 60% figure. That's quite a chunky figure. I mean, we've touched now several times on target market. I don't know, Alexander, if you want to say anything with your EFAMA hat on as well, because I know we've only just got the document back from ESMA now, final on target market, which is interesting anyway, because you've now only got 6 months. But I do know that EFAMA did a lot of work in terms of trying to get those to a better place. I don't know if you just wanted to have the opportunity to say something on that.
I think it's fair to say that with the current Commission, we have really been able to establish a very constructive dialogue that also applies to ESMA and other authorities, EBA, IOPA, IOSCO, to name a few, on all relevant issues. On this particular one that you mentioned, target market, I mean, the first proposal by ESMA was really, again, another example of theory, almost like the PRIPS kit. And we have been able really to not only reduce the number of components or detail you have to basically identify if you define a certain product to certain clients. We have been able to convince them that not all USITS or most of the USITS are not complex products, rather simple products, and the like. So quite a very positive development. And like Rob Taylor said earlier, we are engaging on a permanent basis, basically, with these authorities.
Yeah, and I think it's true to say there's very significant changes from the draft, positive. But I suppose maybe, thank you for that, maybe we should go back to the exam question as we were in the set, and the first bit, which actually really is about what the investors want. And I don't know if you want to lead us into that, what do you see as the end customer actually wanting?
Yeah, well, I think this is all a question of suitability. I mean, I think if you sort of look at what investors want from the entirety of their asset pool, there's not a big list. Essentially, they want either a decent return, or they want a decent level of income, or they want to maintain their wealth in real terms, or in institutional markets, they might want to beat liabilities, so they have sensitivity to interest rates. And I've really not met any clients that with the entirety of their assets aren't trying to achieve one of those outcomes. And of course, in all cases, they want it to happen with as little volatility as possible. The problem we face as asset managers when it comes to suitability is we obviously can design those propositions, but clients aren't coming to us with 100% of their investment problem, and so we only see a portion of it. So I'm fairly confident with some of our solutions orientated, whether it's 100%, 10%, 50%, 30%, it's going to be broadly suitable as long as they've described the outcome that they're looking for, and we can do that. Where we've got what I would call componentry, so maybe it's a highly focused stock-picking fund with 30, 40 funds, that is probably not going to be appropriate for the entirety of their wealth, but maybe highly appropriate if it's a small sliver. And us having a sight of that is quite difficult, because we are not in that position of being the frontline advisor to them.
Yeah. So in that sense, regulation could actually hinder or maybe cause you particular problems in terms of the target market issue that we've discussed. How do you say? Yeah.
Yeah, well, I think the regulation might, the danger with regulation that might hinder, is if you're building high quality solutions that we believe we are, that are trying to target true client needs, a decent return, maybe 5% above cash with low volatility. If you're trying to build that, that's actually quite complex to deliver. Yeah. And there seems to be almost a regulatory preference, I would describe, for simple funds with complex outcomes. So you know that if you buy an index fund, it's cheap. That's the only thing you know. You've got not a clue as to what the outcome is going to be. If you buy a more complex fund, you can't guarantee performance, but you can certainly guarantee that the bell curve of possible outcomes will be less than a raw equity, passive solution. So I would describe that as maybe a more complex fund with a simpler outcome in terms of how you're describing it. But it comes at a different pricing point. Yeah. And one of the things I think, certainly fund managers like I have got to try and communicate is, it's apples and pears comparing, market access propositions are not really fund management. Nobody's thinking about either whether the return, about whether the portfolio is suitable, or the risk. It's just a market access proposition. And it is necessarily much more complicated to stand up teams of professionals around the world to work together to build active portfolios. So there's obviously going to be a different pricing point. And that's a challenge, is what appetite is there for complex funds with simple outcomes that definitely do target client need.
And Jamie, do you see solutions, investment solutions changing, evolving?
I think they have evolved, and I think they will continue to evolve with the use of digital efficiencies as well, because I've sat in many a product development discussion over the years where people that I won't name have said, well, we've got to get into the solutions business, we have to build a solution, and then the question comes up, what is a solution? So I Googled it, and it was a mixture of two liquids where one dissolves into the other to create a solution. Or the second answer was a product or service designed to meet a particular need. And I think the challenge in the early days was that we were sitting in rooms trying to come up with solutions and then thinking, where can we sell these solutions that we've come up with? And we've created a great solution. And I think it's generally accepted now, then every balanced fund became a multi-asset fund, yet a solution doesn't have to be multi-asset if you're focusing on what the particular problem is or the need that you're looking to solve. And to Euan's point earlier, I put clients into three categories. Clients that have income that want to turn it into capital, clients that have capital that want more capital, and clients that when they've got that more capital want to turn that back into income. But within those three categories, you've got varying degrees of risk and return parameters. And you can't say that two people of the same age or gender or demographics have necessarily the same attitude to risk and return. So I think what you're going to see and what you're starting to see, and that's where I think digital has made it far easier, is to properly try and assess an individual's needs and in a digital manner effectively come up with a solution that meets those, as opposed to saying, I've got three types of solution, now which one can I sell to you? And I think where, as we slowly adopt as an industry more digital efficiencies, I think we're going to be moving more towards that. But the other point Euan made about unintended consequences and the advice gap, what you've got now, I think, is the flip side is that in a commission-free market, passives have risen very quickly because of the focus on the price. And I think we will start to shift towards a market where people will be looking more at the net of fees outcome and who can deliver that for me.
Yeah,
That's where we're heading, I think.
definitely. So I suppose, to be honest, I'm now a little confused. So I might ask Peter to help with the confusion, because the question we had is we need to reset the business model to focus on end customer investment outcomes within the challenges of MiFID. But in one sense, what we're describing so far is that the industry's already been doing this in some sense. What's this tension here, Peter?
I think the resetting must have to do with the complexity I started out by mentioning, because we are really into many different games. Just to follow up on the two prior comments. So now we have advisors that are getting paid. It's almost like we forget that. It's not a cost for the end investor to pay an advisor, but the advisor knows it's a cost, so he has to go and find the cheapest possible solution with the consequences that Euan and Jamie rightly put out. So we have to communicate to an advisor who has a different mindset than a distributor who get paid via retrocession, and we have to have a model for everything. And I'm not trying to say that one is better than the other, but it's clear that the way that people are looking at our offerings will be very different. And I would probably say that a 100% advice-based model may be problematic if we are producing outcomes. Because a part of the justification for being an advisor, you charge a fee, is you have to demonstrate you're doing something. So you will allocate. You will pull the different things in, but there is no there's a fiduciary responsibility, but there's no benchmark there. So I think the industry has not moved to more transparency as a whole. There are pockets of more transparency. We could probably have done that without a ban on retrocession. But at the end of the day, this drives off cost because we need many different models.
Okay. Maybe just one last question. Maybe I'll ask Neil, if I may, because bring it back to regulations. So we've heard these comments, and we've talked about transparency for investors. So we have, of course, now under MiFID II, the new disclosure requirements, and we have the PRIP Kid coming in, and we already have the USITS Kid. In what you see in your business, are these helping end investors, informing them take decisions? What are you seeing?
See all sorts of things. Some of it is very interesting and some of it is relatively boring. The relatively boring side is that there's an awful lot of paper being produced, and as was mentioned by the gentleman from the FCA, we all know that around about 15% of it actually gets read, unless you finish up in litigation when everything gets read and taken to pieces. But let's keep to the regular day. And so therefore, you could question, the Kid was a wonderful invention, especially when it said it was only going to be 2 pages. But when you get into prospectuses produced by certain law firms in certain jurisdictions, which run off to 200 plus pages. And a lot of it is somewhat stale and repetitive. Is that really going to help the investor or the trusted advisor, as we all find in Swiss banks, really understand what the offering is? Obviously, there is strategy. That is paramount. The other element is that there's a lot of detail today, and it's not necessarily found in Kids and prospectuses, it's in spreadsheets, invariably Excel, with share classes. Because if you're talking about costs, the fastest way to find the very cheapest share class in a particular strategy or an offering in a sub-fund is by having an Excel sheet and just stacking it by cost, and then looking at whether or not your targeted investor is the one that can subscribe to that. And as we move forward, we're finding that from our business as representatives, but also as interfacing with trusted advisors, is to get down to the share class level, and then once you got down to the share class level, the different criteria, the 5 years, etc., etc. Performance numbers that you actually get a document which is rather brief and not too stale.
I'm afraid on that, thank you for that. I'm afraid on that we need to end because of the time. We don't have time, sorry, to ask questions of the floor. So can I ask you to join me in thanking the panel? Thank you.